Ladies and gentlemen, welcome. Today we have a relatively silent day in crypto. Bitcoin doesn't move much, and I will use this opportunity to tell you a little bit of the technical analysis basics. I just realized that although we did cover many indicators, I didn't tell anything about one of the most widely used RSI. So I will close this gap today. I will tell you what this indicator is, what is the basics behind it. We'll look at the specific examples of how to use it, and the most importantly, we will look at the current situation with RSI and what it tells us. Alright, so Relative Strength Index, or RSI. Simply speaking, it compares the magnitude of the asset recent gains to the magnitude of the asset recent losses on a certain period of time, and makes it in the range of 0 to 100, something like percentage, right? For the calculation, it may sound a bit complicated. So here is the formula. It made with 100 in such a form, so the result will be between 0 and 100. And the main part is this, RS. So RS is the ratio between the average gain and average loss. And basically this is the gist of RSI. It shows you how much price grew comparing to how much price dropped during the certain period of time, let's say 14 periods as a default. So then you have this ratio of average gain and average loss. You can use a smoothing function, and it may again sound a little bit complicated, but just let's look at the example. So here you have a spreadsheet with the values of a certain asset, and then you can calculate the change between every close positions of this asset. So you have, for example, between these 2 days, you have the change 1. So it rose by number of 1 here. You see 46, 47, and the rest is the same. Then it dropped a little bit. So here is the delta, which is negative, and so on and so forth. So then average growth here is like this, right? Then average loss is like this. What you do is you calculate the average gains and you calculate the average losses. Then you simply take the ratio between them, which is here, and use this value to put into RSI formula, and you will have the value between 0 and 100. You see, it's actually a little bit more than 1, but when you see something like 51, more than 50%, it's easier to interpret. Of course, you can smooth it, as I said, by the formula, but it's a little bit different thing. So basically, once again, what it does, it calculates the ratio of the magnitudes between the average gains of the asset to average losses. Of course, the size of the rises for all the candles you have on the chart could differ from the drops of the red candles which you have in the chart as well. So in that way, RSI may be different from the price evolution. And in principle, it somehow shows you the cleaner data with respect to price. So one may say that it is more honest comparing to the price action. Alright, so then what you can do with RSI is, of course, you can look at the extreme values. For example, here the value was very high, not 100 of course, but very close, like almost 90, and it was the peak of the previous rise, $14,000. So at this area, which is overbought, you may expect the reversal of the trend, the drop of the price, and you see, yeah, this happens. Of course, the bigger time frame you use, the more reliable this estimation is. Now, if you have the very low value of RSI, then this is oversold territory, and you may expect the rise in the price. But let's look at this oversold value. For example, here you see it was very low. It was the lowest point in a very long history, but at the same time, the price here was only $4,500, and it actually had more drop to almost $3,000. So you would say that it's not that reliable. Indeed, this is not a 100% correct signal. Of course, you need to use other indicators, you need to use price action analysis and everything. But this is another example, another interesting point here. So another way to use RSI is to look at the divergences. Divergence is when the price and indicator behaves differently. And again, I must tell this once again, stress this out because it's very important. Many people misunderstand that and there's a lot of confusion. So what they say is, for example, you have the price going down, right? You can draw this line, right? This one. You see, this is the trend. Price is going down. At the same time, you can say that the trend, this kind of mean value of the indicator, is going up. And this is divergence, right? Price is going down. The value of the indicator is going up. That's why you may expect the reversal of the trend. Indeed, we saw the rise after that. But this is incorrect. I will refer you to this chart once again. Those are divergences. When you look at the bearish divergences, you would have to consider only the tops, only the highs of the price, not the trend, not the lows, only highs of the price, and at the same time highs of the indicator. They may be different variations, but always for the bearish divergence, it is for the highs. For the bullish case, it's opposite. It is for the lows. It's never for the trend, it's never for the highs, it's always for the lows for both indicator and the price. For the variations, of course, for example, if you look at the bullish divergence, lows can go lower on the price, but higher on the indicator. This is regular divergence, the strongest one. It may be opposite actually. Price is going high, indicator is going low, but it's still a bullish divergence, although it is so-called hidden divergence. And there are also exaggerated divergence when you have the flat lows and higher lows for the indicator. It is still bullish. So be careful when you make your assessment with trying to spot those divergences and don't mix them. So here, what do we see? The lowest point for the RSI, this was the low. The next low is over here. Let's see how the price was at the same time. The low was here, the next low was lower. So lows are going down on price. On the indicator, they are going up. This is bullish divergence because we are looking at the lows. And also it is very important to look at the low for the price and the same, absolutely the same low on the indicator. Moreover, for example, you can't compare this low and this low because there is another couple of lows in between them. You need to compare the neighboring lows. Again, you can look at the other pair here and here. They are going down on price. They are going up in the indicator. And the next one, going down on price, going up on indicator. Strong bullish divergence with consecutive 3 pairs of the lows both on price and the indicator. And after that, you see we had basically the lowest point in our bear market. All right, let's look at the top of the previous bull market and see if there is any bearish divergence out there. Okay, so let's look at these 2 major highs. In fact, as I said, you probably would have to include this one, but here is the tricky thing to define where it is the high or not. And if you will actually have, like, let's say 3 days time frame, it will be a bit different and cleaner. So again, higher highs on price, lower highs on the indicator. In fact, again, if you'll compare these two, then you will see it's also a lower high. But this is the regular bearish divergence because we are looking at the highs. And what we see after that, bear market for the next year. All right, then current situation. In fact, we can start it from the beginning of the year when we had the rise and our lows were going up, the same as our highs. So for example, you can see that this high on the indicator and this high on the indicator, they're almost the same but a little bit declining. So you may say that around here, when you spotted this decline, while this high is higher than this one on price, you may expect a correction. It did happen, indeed. Next example is even more pronounced. This high and this high. It is growing, right? But on indicator it is going down. This is another bearish divergence. Again, you can adjust the time scale, but if you look at the major highs, this one and this one, then you would see that highs are going up here, highs are going down. So again, this is another bearish divergence, and we saw the drop in the price after this overbought condition. But at the same time, in between of that period, and actually both periods, you may notice that the lows, for example, this low and this low, of course they are going up, right? But on the RSI, they are going down. This is bullish divergence, although this is a hidden bullish divergence. And you can see that after that, we see the rise in the indicator, we see the rise in the price. You can find more example on that. And during the current correction, you see the decrease in the highs, you see the decrease in the highs in the indicator, you see decrease in the lows, you see decrease in the lows in the indicator. And now let's look at the 4 hours time frame. And here what you can see is starting from $9,500, we see the higher highs, we see the higher lows, and the indicator pretty much worked in the same way. Then we had the highest point at $12,200, and we have the lower highs, which is also converging with the RSI, lower highs, right? But what is also interesting that at the same time we have higher lows on price and we have lower lows on RSI. In fact, you can include this one and compare these two lows and these two lows, etc. So this is a hidden bullish divergence. In fact, it actually had this spike recently, so you may say that to some extent this divergence already played out a little bit, but I would say let's wait for the new low to be formed. Where will it be, below this low or not, and then see whether this divergence will extend, and then we may expect a continuation of the growth or not. But anyways, now you see how powerful this indicator is and how the proper use of this indicator may help you to make right decisions when you're opening or closing your trade. Alright guys, that is it for today. I hope that it was useful. Thank you for watching.